Good afternoon and welcome back everyone to another options education webinar series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and we are kicking off another earnings season. So far, earnings season off to a fiery start. So let's take a look at where we currently stand and what our outlook is going forward and how you can potentially use options to harness the volatility that is earnings season. So before we get started, what we are dedicated to you every single Thursday with these options education sessions is our commitment to empower you to trade sustainably and confidently. We want to make sure that you have a well-rounded education, not just around option strategies, but around everything that you need to become a better trader, a sustainable trader, and be able to confidently grow your trading account. So for those of you that are joining us for the first time, welcome. We host these sessions every single Thursday and make these recordings publicly available so that you can follow along and learn how to utilize different tools, different methodologies to incorporate into your trading to help you sustainably and confidently grow your account in the long run. If you're joining us for the first time, please feel free to chime into the chat window. As you can see, some of you have already started to chime in with who you are and where you're from. Please feel free to introduce yourselves. As you can see, there's a very vibrant community of traders during these sessions here at OptionsPlay. So don't be shy. Let everyone know who you are, where you're from, and you can see kind of the large group of people that are here every single week to improve their options education, their trading, and many of you kind of have helped each other along through the process and through the journey. Now, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any of the specific securities that we'll be using as example purposes during today's session. So we'll start off by taking a look at kind of a bit of a preview for the earnings season this particular quarter. We'll kind of introduce some of the best and worst sectors to pay attention to. And then we'll show you kind of the upcoming earnings calendar, specifically the OptionsPlay earnings calendar that will help you significantly reduce the amount of time that's to research the upcoming earnings season and which symbols to pay attention to. And then I'll talk you through kind of my process for earnings research, what I typically look for as I look at the earnings calendar and try to seek opportunities. What is my process? Go through some live examples and then show you kind of the optimal option strategies that allow you to harness the volatility that is the upcoming earnings season. So the primary thing that I want you to be able to walk away from today's session is a clear understanding as to how can I trade earnings season with confidence and maximize my returns utilizing options. Earnings season is a volatile time. You're going to get lots of movement in both directions, to the upside and to the downside. How do you take advantage of it while minimizing risk? That's really the key. And the key to doing that is to utilize options. And we'll kind of show you the different option strategies that you can utilize during earnings season. And the question that I always get from these sessions is, are these sessions recorded and can I get the slides afterwards? And the answer to both of those questions are yes. You can, if you don't already have an OptionsPlay account, you can sign up at optionsplay.com/sign up or point your phone to that QR code. That will get you access to the OptionsPlay platform and the tools, which means that we will be able to reach out to you once we post the sessions with the link and the recording so that you can watch along and follow along at your own pace with the slides. So we posted that link into the chat window for those of you that want to click on that, or like I said, you can point your phone to that QR code on your screen. It takes literally 10 seconds to sign up, and that will get you access to the recording and slides when we post them this weekend. So let's take a look at kind of what our expectations for earnings season is heading into Q2. And before we do that, let's take a look at kind of how did Q1 shape up. So EPS ended up growing by about 5.9% year over year. That's considerably higher than the 3.5% that was expected at the beginning of Q1. So the bar was set, I would say, fairly low at the beginning of Q1. So we were able to beat that by a pretty significant margin. Revenue came in at about 4.3% year over year growth versus the 3.5% that was expected at the beginning of the quarter. So, we did end up having a Q1 that was quite positive overall, with both top and bottom line beating analyst expectations. And the S&P 500 responded quite positively to the overall earnings season, which was Q1. You did see a slight increase in terms of margins to 11.8% year over year for the S&P 500 versus the 11.6% that was expected. So overall, we had a pretty decent Q1 earnings season. 89 and 88% of tech and healthcare companies beat their earnings. Those were the two best sectors from a performance perspective, where nearly 9 out of 10 stocks beat analyst expectations, versus energy was the biggest disappointment. 30% of all energy shares missed their earnings expectations. So, and kind of the response from market participants was fairly balanced. Certainly not skewed to the upside. Beats gained about 0.9% a day after earnings, versus misses were down about 2.8%. So certainly skewed a little bit more to the downside, but a lot more companies beat than miss, which is why we continue to see the S&P 500 continue to gain. Now, going into this quarter, the bar is set substantially higher. As you can see, EPS expected year over year growth is about 8.9%. And as of right now, we have about 5% of the S&P 500, a little over 5% of the S&P 500 has reported earnings already. We're coming in at about 9.3, 9.4% so far growth year over year in terms of EPS. So the bar was set pretty high, and so far, based on early reports, we are slightly above where the bar has been set. Revenue is coming in at about 4.7% higher than last year, which also, like I said, is the bar set quite high. And this is really where the risk lies, in my opinion, because of how high the bar has been set. Misses, are going to likely have some concerns with regards to, how big of a decline we might see on misses, but even on beats. And we'll talk about that here in a second. This is some of the more important metrics that I pay attention to going into an earnings season, rather than just what expectations are, but more so how are markets reacting to beats and misses. I think that tells us a lot about how to position, how to take advantage of different opportunities that we see here in the markets going into this earnings season. When we look at the sectors, what we typically look at are revision ratios, meaning where are analysts changing their expectations or their estimates going into the earnings season? Which sectors are they seeing the most positive revisions, and which sectors are seeing the most negative revisions? Because positive revisions reflect an analyst doing their work prior to earnings season and maybe recalculating what their expectations are. And when they revise their expectations higher, that reflects more positive news, more positive expectations, versus negative revisions refer to sectors where there are more analysts revising those estimates lower, right? So a worse outlook. So tech, healthcare, and financials have seen the best revisions ratio. This is where analysts are revising their estimates higher the most in those specific sectors. And we're seeing energy and materials seeing the worst revision ratios right now. So that gives you some sense as far as how analysts are, where they're seeing the most positive versus the most negative outlooks with regards to the individual sectors. Now, the one thing that I do think we need to really kind of pay attention to is the fact that the S&P is now trading at 21.5 times forward earnings. That's a pretty substantial margin higher than the 10-year average, which sits just under 18 times forward earnings. So this is something to consider because, as these companies trade at these relatively rich valuations, it just simply means that upside is going to be more limited than when valuations are either on average or below average. So as you're looking for opportunities here to the upside, you need to be cautious with regards to the valuations that the companies are trading at and whether or not you believe that those valuations are justified or whether or not they can continue to expand in terms of valuations given the outlook that you have on each individual company. Now, one of the things that I think is this is more so kind of, I would say, a feature of kind of how high the bar has been set. But so far, 81% of the roughly 6% of the S&P 500 that's reported have beat on EPS, have beat on earnings, but only 56% have beat on revenue. So that EPS number is coming in very much around average, but that revenue number, only 56% of companies beating on revenue is coming well below average. And this is really where, this, in my opinion, the risk starts to lie, right? Because earnings, to some degree, you can manufacture. You can reduce your spend, and that kind of increases your earnings, so you can reduce expenditure. But what you can't really manufacture is revenue, right? You either have the revenue or you don't. Even though revenue, the bar is set pretty high, 4.7% revenue gain year over year is nothing to sneeze at, but that bar being set so high, a lot of companies are failing to meet that bar. So this is really where you see it in the reactions, right? Stocks that beat on earnings actually on average declined by 20 basis points. Normally you see stocks that beat on earnings at the very least have a positive reaction, at least on average. But right now, so far, even though it's very early in the quarter, and so it's hard to say that that's where we're going to end up, but and we have seen this previously, especially in 2023, we saw a lot more of this, where even when stocks beat on earnings, they actually saw either no move or actually a small decline. And stocks that missed on earnings so far coming in very similar to last quarter, down about 2.9%. So that further kind of what's the right word? Influences your views or should influence your views going into earnings with regards to kind of what type of opportunities do you chase, right? Because stocks that beat on earnings are not rewarding you with big moves here to the upside on average. But stocks that miss on earnings are seeing some substantial moves here to the downside. So that kind of skews your view in terms of what you look for in terms of opportunities, because beats are simply not going to give you that big move here to the upside, at least so far what we've seen in the quarter. It's not producing that. So it's important to understand that metric going into the earnings season. Does that make sense, everyone? Please type 1 into the chat window if that makes sense to you. So earnings season so far, off to a rocky start, I'd say. Decent start on the earnings side, a rocky start on the revenue side, and revenue is really kind of the part that you can't manufacture. And there are some signs of weakness, in my opinion, on the revenue side of things. And that, reflects also kind of and also at the same time when the S&P is trading at such high multiples, the downside risks, I would say at the moment, are higher than the upside risks. So looking at the earnings calendar, this is something that's unique to OptionsPlay. We built the OptionsPlay earnings calendar to make it as easy as possible for you to navigate earnings season. And you can find the earnings calendar by clicking on the hamburger menu, which is on the upper right-hand corner of your OptionsPlay platform. Let me make this a little bigger so everyone can see. If you click on the hamburger menu on the upper right-hand corner of your OptionsPlay platform, you click on earnings. Within the hamburger menu right here, that will get you to our earnings calendar. That is your navigator for earnings season. And what I mean by that is that if you look at a traditional earnings calendar and you look at a date sometime next week, you're going to see, pick Tuesday, Wednesday, Thursday next week, or even the following week, Tuesday, Wednesday, Thursday. You're going to see hundreds and hundreds of symbols that are reporting on a given day. The vast majority of symbols you may have never heard of. They're symbols that you're not familiar with, but they're listed in alphabetical order based on what's reporting on that given day. And that is incredibly difficult to navigate when you have 300 stocks on a given day and you have to figure out which symbols you recognize for that day before you can do your research. So what we do is we organize the calendar not by alphabetical order, but by liquidity. Because if you're going to trade options for earnings during earnings season, you really should only trade options on stocks that are extremely liquid. Because during times when things are volatile, you want to be able to get in and out very quickly. You don't want to be stuck in a trade, not be able to get out of that specific security because it doesn't trade very often, or because when things get volatile, spreads get widened out. So really what we look at are stocks that are very liquid. We know that they trade basically at the midpoint all day long, no matter how much volatility there is in the underlying stock, because the stock trades, at least a couple of million shares a day. And that's really kind of how we organize our earnings calendar. We first organize by liquidity, then we organize by AM versus PM. So if we look at the date, let's say next week, like July 23rd, if we look at the area shaded in green, that's referring to all of the most liquid symbols that are reporting on that day. So basically anything outside of that green window, I generally don't bother taking a look at, because I know I'm going to probably have a tough time trading options on those specific symbols. There's no need for me to research the technicals, the fundamentals, the business if I can't trade options on it. So this is designed to help me filter out about 95, 97% of all symbols that are reporting on any given day right off the bat. So I don't have to look through an earnings calendar, figure out what I want to pay attention to for that day. And then, as you can see, the top 10 or so names on that date have an asterisk sign next to it. What that tells me is that those are the ones that are reporting in the morning. The ones without the asterisk sign, like Chubb, Enphase, Alphabet, Seagate, Tesla, those are the ones that are reporting after the close. So this helps me organize also in my day, right? Because the ones obviously that are reporting in the morning, I have to execute a trade the before the close of the previous day. And then the ones that are reporting after the close, I can execute a trade up until the close of that day for that trade. So it helps me organize my date, my timing, as well as liquidity. So this is my navigator. I only bother researching the stocks, generally speaking, in the green area. Occasionally, I'll find my way navigating my way to the orange area. I'm sorry, the yellow area. Yellow stocks are what we call somewhat liquid. So these are stocks that are, generally speaking, still reasonably liquid, and you should generally have the ability to trade these around earnings season, but they're simply not as liquid as the ones that are in green. And then anything that's not colored, like everything down here, those are things I won't even touch. Those are things that are just simply not liquid enough to be trading around earnings season, especially when things get really volatile or could potentially get really volatile. And this is really helpful for anyone who's trading earnings to be able to know what symbols to start researching for a given day. So for example, if let's say, we're going into the close of the 22nd, I know that I'm going to research, these 10 stocks. Right? I don't have to pull up an options chain. I'm sorry, I don't have to pull up an earnings calendar and figure out of the 300 stocks we're reporting the next day, which ones do I want to research. This helps me narrow it down to just 10 stocks. And, obviously on that list, there's quite a few that jump out: Freeport-McMoRan, GE, Coca-Cola, Lockheed Martin, Spotify, UPS. Those are kind of big household names that anyone recognizes. You obviously know what those businesses do. You probably have a view or hunch on kind of how those businesses or industries are doing. And that is kind of what you use as the groundwork for your research. And then, by the afternoon, I'm looking at the other symbols really for this on this given day: Alphabet and Tesla. Those are the two big ones that are reporting. Those are probably the only ones that I'll have time to research and potentially place a trade on. And this will save you hours and hours of research looking around earnings season, because you're really narrowing down hundreds of symbols to just a few that you're going to spend the time to dig a little deeper and find opportunities during earnings season. Does that make sense, everyone? Please type 2 into the chat window if that makes sense to you. So if you're already on a free trial for OptionsPlay, if you currently have a membership for OptionsPlay, you have access to this earnings calendar. This is, like I said, one of the most important tools for me to navigate earnings season. So if you're joining us for the first time, if you're joining us and you don't have an OptionsPlay account, this is one of the reasons to sign up for that free 30-day trial, so that you can have access to this calendar that's going to significantly help you navigate earnings season. Okay. And today what we're going to look at is American Express, because this reports tomorrow morning. Obviously too late at this point to execute a trade for American Express, but this was a trade that many of you have followed me in the past couple of weeks on an American Express trade. We actually ended up closing the trade just yesterday on this because the stock has run substantially going into earnings that actually exceeded our target price. So we ended up closing it. But I'm just using it as an example because many of you have followed me along on this American Express trade over the past couple of weeks that we even added to, and we simply took profits on this particular trade going into earnings this week earlier. So taking a look at kind of some earnings research, I'll actually take a trade that we took earlier this week, which was Morgan Stanley. We entered the Morgan Stanley trade back when it was trading around 97 or so. We entered a bullish position here when it was around 97, and then when it got up to 100, we rolled that position up to 100, and then when it got up to 104, we rolled it again. So we basically took two positions on Morgan Stanley going into earnings, and then held a third position going into earnings. On the back of what looked like both absolute strength and relative strength. Those are two probably the most important things to pay attention to on a chart. If you're going to do research on a stock going into earnings season, what you generally want to see is a combination of both things. If I don't see both, it's usually not a good enough trade for me on an earnings play. Because what you generally want to see is that the stock is trending, generally speaking, in the direction that you are expecting the stock to perform, right? So, for example, if you have a hunch in terms of the overall business or the industry, it's going to do well during earnings season. Well, number one, that should be reflected in the chart, right? So you want to start seeing some absolute strength. So meaning a stock that's trending in the right direction. In this particular case, what we specifically did is we looked at Morgan Stanley, which had been trading range bound, under this $92 range, and have broken out above this finally after a full year of trading in this range. And you can actually go further back if you draw the lines this way. So this stock finally broke out above 92, rallied all the way up to about 102.5, and came all the way back to retest these levels as support. So that was kind of our initial entry on Morgan Stanley, was that, the stock broke out, it came back to retest these levels as support, and we thought that this can start running from here, right? So that's how we entered the initial position, the second position, and we finally entered a third position going into the actual earnings event. So we want to start to see confirmation of the strength from an absolute basis, looking at the underlying chart. And then what you really want to confirm that with is relative strength. You want to see that not only is it performing relative to itself, it's performing relative to the market. You want to see outperformance on bullish opportunities. You want to see underperformance on bearish opportunities. Does that make sense, everyone? Please type 3 into the chat window if that makes sense to you. And for those of you that might be asking, how did I get the relative strength? So I use stockcharts.com for this specific chart. And what you can do on stockcharts.com is you can plot any specific symbol. In this particular case, Morgan Stanley, I'm plotting Morgan Stanley relative to the S&P 500. And what this chart tells me is that when this chart is going down, the stock is underperforming the market. And when this chart is going higher, it's outperforming the market. It's pretty simple to read. Basically, if it's rising alongside the absolute chart, then not only is the stock performing, it's actually exceeding the overall market. So when the stock is beating the market, that's telling you that other people are also paying attention, right? That people are buying Morgan Stanley stock faster than they're buying the rest of the market. That's indication of something positive going into the earnings announcement. Doesn't always work out, but this is one of my metrics that I must have before I take a bullish or bearish trade going into earnings season. I must see outperformance. If I'm going to take a bullish trade, I must see underperformance if I'm taking a bearish trade. Those are my specific rules for trading earnings season. So looking at American Express, so that was the one that we did for Morgan Stanley. So looking at American Express, we have a similar type position, right? And we had originally taken that position in American Express, similar to Morgan Stanley, from the perspective of this had been a strong stock here, and I pulled back substantially to this 220 support. That's kind of when we started taking on our long position here. Our price target on it was 240, and we actually hit that target a couple of days ago. And we actually were able to get out of this trade a few days prior to earnings. We were expecting to hold this trade through earnings and having that earnings be the catalyst that drives this stock higher above that 240 resistance. But the stock actually started to take off, as soon as we got into the trade, and really took off a couple of days ago, that we ended up just taking profits on this specific trade. But what you have is absolute strength and relative strength going into the earnings announcement, which is going to be tomorrow morning. So if we had not taken this trade and you were taking a brand new trade in American Express, these are the things that you would want to see going into the earnings season. Relative and absolute strength that align with each other, right? Because many times you can have stocks that are trending higher, right? So for example, notice how this period of this stock, right? It was trending higher. And this might not be the best example. But generally speaking, you will see sometimes where the stock is trending higher, but the relative strength is actually moving flat or even slightly moving lower, right? And what that's telling you is that even though the stock is moving higher, it's not moving higher any faster than the rest of the market. And sometimes you can be moving higher and be very deceptive because maybe the markets are up 10%, but the stock's only up 5%. So this is a stock that's actually underperforming the market. And that's incredibly important, very important information going into the earnings announcement, because if you're thinking to yourself, oh, the stock's up 5% over the last month, great, this is a positive bullish trend. But then you realize that the market is up 10% in that same amount of time, and this stock is underperforming the market, then other investors or the market participants are telling you something. That's information that's important to understand, because that's saying that the rest of the market is buying the stock slower than they're buying the rest of the market, meaning their outlook on the stock is not particularly positive. So that's why relative strength is so important when you're thinking about going into earnings season, because it tells you how other people are thinking, not just whether the stock is trending higher or lower. Okay. And then lastly, what you need to do is you need to, at least for me, I need to also at the same time justify it from a fundamental perspective. And that, generally speaking, comes down to a few different metrics that I look at. And for those of you that follow me on our research that we post every single Monday morning, you know that we posted American Express as a research idea a couple of weeks ago when we laid out a trade idea just like this, where we look at the technical picture and then we also look at the fundamentals. And what I'm generally looking at is the valuation and the growth rates and the profitability of the stock, right? Because valuation is simply a function of how fast the company is growing and how profitable the company is, right? Those are the two main factors that go into valuations. There are other things as well, but at a high level, those two things explain a good percentage of a company's valuation. The faster the company grows, the higher the valuation. The more profitable a company is, meaning for every dollar they make in revenue, what percentage of that did they turn into a net profit? That also is a huge component of valuation. The more profitable a company is at extracting profits from their revenue, the higher the valuation, and vice versa. The slower the growth rate, the lower the valuation, the lower the margins, the lower the valuation. So what you generally, once you start looking at those two metrics in conjunction with the valuation, you start to get a feel for what is an appropriate valuation for the given expected growth rate of that specific company. So American Express at the time was expected to grow EPS at about a 14% growth versus and revenue growth of about 8.69%. Okay, so that's the expectation in terms of revenue growth. Now, remember what we looked at here before. What was the earnings season expectation going into this particular year over year? Was 8.9%. So the average S&P 500 stock is expecting to grow revenues by about 9%, expecting to grow revenues by a little under 5%. In this particular case, American Express was expected to grow about 14%, right, in terms of EPS. And revenue was, I forget what the number was, 8.6%, right? So, so this was the average was 8.9% for the S&P, and the revenue was like 4.5, I said. So as you can see, the expected growth rate for American Express is quite a bit higher than the average S&P 500 stock in terms of earnings, and quite a bit higher in terms of revenue. And like I said, revenue is much harder to manufacture than EPS. Even though EPS arguably is more important than revenue, but I would say that a lot of times when you see companies with really high EPS expectations or really low EPS expectations, take a look at the revenue numbers, see if it aligns, right? Sometimes you see companies with really high EPS expectations, but revenue is actually, pretty marginally or just around average. That tells you that something's not quite right, that the company is growing on, basically on par with the rest of the market, but somehow they're manufacturing better than expected earnings. Maybe they really slashed expenses. Maybe they laid off half their workforce to make their earnings look good, but they're actually not really growing that fast. So you got to look at both, and the two have to make sense to what you're seeing, right? They have to make sense relative to the industry. It has to make sense relative to the market. So what we see is that American Express, it's expected to grow at quite a bit faster pace than the rest of the market. It's got decent margins, 14.5% net margins. Not spectacular margins. Spectacular margins are like 20-25%. That's what we would consider spectacular margins. And then if something really low margins is like single digits, 4, 5, 6, 7%. Those are kind of poor margins, right? The average S&P 500 stock margin is about 11.8% we said last quarter, right? So this is a little bit higher, 14.51%. So higher than average margins, higher than average growth rates, yet it's trading at a multiple of only 19 times forward earnings. We said the average S&P 500 stock is trading at 21.5 times earnings. So you're talking about a stock that's trading nearly a 10% discount from a valuation perspective relative to the S&P 500, yet it's growing at a pretty healthy pace, higher than the average S&P 500 stock. It's got margins that are higher than the average S&P 500 stock. And this is an overall positive outlook for the valuation, right? Meaning if you're buying American Express stock at $250, you're paying a valuation that's cheaper than the average S&P 500 stock, with an outlook that's actually better than the average S&P 500 stock. Does that make sense, everyone? Please type 4 into the chat window if that makes sense to you. So that was basically a 5-minute masterclass in thinking about valuations, right? And this is something that we publish in our Monday morning research every single Monday. So we post about 5, 6 ideas like this, where I lay out the idea, the technical picture, the fundamental picture, and how I'm viewing these specific valuation metrics. So if you want to learn more about this with some more examples, come to those Monday morning sessions, read the Monday morning research, because that's where I will post these ideas. American Express was one of these ideas we posted a few weeks ago, and we took the trade for our daily play as a result of it. But that is, generally speaking, the thought process that I look at. And there's no exact science to how to do this, but you start to get a feel for this after the fact, right? And, and as I talk through this, what I'll do going forward is I'll actually post what is the average or what the market's expecting from the S&P 500, and you can use that to gauge, is this stock growing faster or slower than the average? And what is the valuation relative to the average? So those are some of the things that I typically look at from a fundamental perspective, right? So you have a technical picture on American Express that's trending higher. It's outpacing the markets as it trends higher, meaning investors are buying it faster than they're buying the rest of the market, and it trades at a valuation that's more compelling than the average S&P 500 stock. So this really kind of ticks all the boxes that I need going into earnings trade. And none of this stuff is foolproof, but those are my non-negotiables going into earnings season. Before I take an earnings trade, I must see that performance, the relative performance, the absolute performance, and a valuation that I can get comfortable with, looking at the valuation that it's currently trading at, once I consider how fast it's growing and how high the margins are. Okay, and it's that combination of all those things together that form my opinion as to whether I take a bullish or bearish earnings play or I don't trade it at all for that earnings season. And vast majority of the time, you don't get everything lining up the way that it does, right? You might have 2 out of the 3 that line up, but for me, 2 out of 3 is not good enough. I need to have all 3 aligned in order to take a bullish position or bearish position going into earnings season. Okay, so with that, let's talk a little bit about once you do find one of these opportunities, how do you actually trade it utilizing options? And this is really where there are 2 schools of thought with regards to how to utilize options. And it really comes down to how much do you think, or how compelling is the research that you've done, right? Do you find a stock that's clearly trending higher? There's a credible amount of relative strength, and it's trading at a valuation gap that's pretty far from where you think it should be trading. American Express is an example where the valuation gap here is decent. It's actually pretty decent here, right? Trading at 19 times forward earnings, when the fact that the margins are substantially higher, the growth rates are substantially higher. These are the types of stock that maybe trade at 23, 24 times earnings on average, right? And if American Express ended up trading at 23, 24 times earnings, that would be a substantial amount higher from the 250 that's trading right now. So maybe you believe that this stock could gap substantially higher from here. And you can use kind of those valuation metrics to also gauge how far do you think stock can go. So it really comes down to whether you think that there's a pretty big gap between where the market is and where it should be, or there's a relatively small gap between where you think it is versus where you think it should be. And because that's going to influence your views as far as which strategy you want to trade for earnings season. So what we're going to first cover is when you have a strong directional view, when you feel that there's a pretty significant gap between where the stock is and where it should be in the future. And this is really where we turn to a debit spread variation that I call the 3x1. A 3x1 is basically, you typically go out about 30 days to expiration, which is a little shorter than what you typically use on a debit spread, but you use a shorter dated expiration because this is an earnings event, and you don't necessarily plan on holding on to this trade for a very long time. You might even use a slightly shorter dated one, maybe even 21 days sometimes, depending on how confident you are that you're not going to hold on to this trade for very long. So shorter dated options to start off with. And what we do is we typically buy an out of the money option as opposed to an at the money or slightly in the money option that we typically would use on the debit spread. We usually go out to about a 40 delta. So on American Express, when it's trading around 250, that would be about the 255 strike. So slightly out of the money strike. Usually it's about 1 strike out of the money. And then what you're going to do is you're going to sell a 1 standard deviation call against it. Basically, you're selling the expected move. In this particular case, roughly 275. So you're buying a slightly out of the money call option, selling an out of the money call option that's about 1 standard deviation away. And the reason that we call this a 3x1 is because what you pay for this debit spread should be roughly 25% of the vertical width. So a 225, 275 debit spread is a width of $20. You're paying roughly $5. 25% of that vertical width. In this particular case, as you can see, we're paying $5.25. So just a slightly over 25% of the vertical width. And it's called a 3x1 because if you pay 25% of the vertical width, you should get roughly a 3-to-1 risk to reward ratio if you are correct on your analysis and the stock does gap higher on earnings. So if it gaps up to 275, your expected risk to reward on this particular trade is roughly 3-to-1 if you hold it to expiration. That's why we call it a 3-to-1. It's a variation to what we typically do on the debit spread, which is much closer to a 2-to-1 or a 1.5-to-1. This is specific one, a variation that you change for earnings season. And these are the types of trades that once you get right one time, you kind of make up for quite a few losses during earnings season where you didn't quite get the directional view right, or you simply didn't get the view correct. You get a very high risk to reward ratio for a relatively low probability of success is the type of trade. And this is something that you need to be prepared for, is that it's not easy to find these stocks that make huge gaps on earnings, but they happen a lot during earnings season. And if you want to try to capture it, you use these types of strategies to capture the big moves in the underlying stock. And especially when you see a valuation that's really compelling, that's pretty far away from where you think it should be, these are the types of stocks you want to use the debit spread, the 3x1 debit spread variation for this type of trade. Does that make sense, everyone? Please type 5 into the chat window if that makes sense to you. Perfect. Okay, let's take a look at the next trade. So let's say you have another trade where you have a good looking chart. It's performance, outperforming the overall markets, but the valuation is closer to where you should be, right? It's still perhaps slightly undervalued or slightly overvalued, but it's not too far away from where you really think it should be. And for those stocks, maybe you think that the stock is going to move in the direction you expect it to, but you're not expecting it to make this huge jump, where it's, a gapping 10% higher or 10% lower. It's maybe it moves 2-3% in a day or something like that, which is far more common, right? If you look at the average miss, it's about 2.9%. So for those stocks, what you want to do is you want to use a credit spread. So the credit spread that we use is our standard credit spread. You go out 45 days and you sell the at the money call or put, and then buy back a 25 delta call or put against that. So when American Express is trading at 250, what we're doing is we're selling the 250 puts and then buying a put option that's about a 25 delta, which in this particular case is 240. And the goal here is to collect at least 1/3 of the vertical width. As you can see here, we're collecting $4.32 on a $10 wide credit spread, which means that we're actually collecting 43% of the vertical width. That's substantially higher than the 33% minimum that we're shooting for. And that simply means you're going to get a better risk to reward ratio on these types of credit spreads. And you generally tend to find these really high percentages of the vertical width on a credit spread going into earnings season, going into an earnings event, because that elevated implied volatility of the short option that you're selling, that at the money option, is the highest. And that's when you typically can capture these types of really elevated premiums going into an earnings event. You have defined risk. These are usually about a 1.5 to 1 risk reward ratio. So for every $1 you risk, for every $1 you can potentially make, you're risking roughly $1.50 on the back of it. But these are ones that typically have a much higher probability of success. So if you can get that directional view correct, even if it doesn't move at all, you're going to be able to capture, a pretty significant portion of the maximum gain of these types of strategies. And that's kind of the nature of selling credit spreads, is that once you sell a credit spread, 3 things can happen. The stock can move lower, it can stay sideways, or it can move higher. And 2 out of those 3 scenarios, you will make money on this specific strategy. Only in one scenario where you absolutely get the view wrong do you lose a roughly 1.5 times what you can potentially make on this specific trade. And that's why credit spreads are quite useful around earnings season. It just really depends on how much our market's moving relative to beats and misses, right? So right now misses are moving quite a bit, right? 2.9% to the downside on average. Beats are not moving very much. So, that kind of helps you inform your decision as far as which one of these 2 strategies you might want to use, depending on whether you think a stock's going to beat or miss. And then also, whether it beats or misses might also influence, which one of these 2 you use, just based on the size of the move that we've seen on stocks that miss. It certainly speaks to debit spreads perhaps being the right, a better strategy for that type of outlook for a specific earnings play. So with that covers what I wanted to share with you here today. I hope that this was helpful in giving you a better understanding of kind of the upcoming earnings season, how I'm planning on navigating, what I'm looking for, and what tools you have in your toolbox to help you navigate the earnings season around the earnings calendar and the Monday morning research that we put out every single Monday morning to help you hone your skills with regards to kind of taking the technical and fundamental picture put together to inform your decisions going into earnings season. So like I said, if you don't already have an OptionsPlay account, if you want access to the earnings calendar that I showed you and the Monday morning research that I post every single Monday. You can sign up using the link on your that Philip just posted into the chat window, or you can go to optionsplay.com/sign up, or simply point your phone to that QR code to sign up for your free 30-day trial. That will give you access to everything I showed you, including the recording and the slides that we are using during today's session. So with that, what I'll do is I'll open this up for Q&A. There is a Q&A window at the bottom of your screen. If you could please type, if you could bring that Q&A window up, type in your questions, and I'll try to answer as many questions as possible going into before I have to sign off. How do we follow your trades? So being a member is the best way. We email you every single day when there's a trade update. You also are invited to my Monday morning market outlook session, which is only for members. That's when I give you an overview of the markets, equity markets, bond markets, currency markets, everything, the individual sectors. And then I lay out ideas like what I did with American Express a few weeks ago. I usually have at least 4, 5, 6 ideas that we present, stocks that where the technicals and fundamentals align with each other. It really gives you a good sense for how to incorporate technical and fundamental into your workflow. And the more examples you see, the quicker you're going to catch on the next time you look at a valuation. You're going to have a much quicker grasp as, okay, that value makes sense or that valuation doesn't make sense, as you see more and more of these examples, what companies trade for versus what they're expected to grow at, what their margins are. A good example of this is Costco. It trades at nearly 50 times forward earnings. Yet it's expected to grow basically on par with the rest of the market. EPS growth is about 11% and 10%, which is on par with the average S&P 500 stock. Revenue is about 6-7%, which is marginally higher than the average S&P 500 stock. And then net margins are 2%. So you're talking about margins that are substantially lower than the average S&P 500 stock. Yet it trades at 50 times forward earnings. So that's what I mean. It's like, something isn't right there, right, with a name like Costco. So the more examples of that you see, the more you're going to be able to kind of capture very quickly, okay, this valuation makes sense or this valuation doesn't. And that's going to help you inform and add a different layer to your research as you look at your charts and look at your ideas to kind of make sure you understand the business fundamentally before you decide to invest one way or another. There's a question as how do I pick directions for earnings? Hopefully today's session kind of really laid that out for you. What is the most useful indicator for earnings trade? If I had to gun to my head, one specific indicator that's most useful is that relative strength. And seeing if the rest of the market is buying, what that stock is selling, this relative strength, if gun to my head, if I had to look at only one thing, that would be the one thing I would look at. Is the stock outperforming going to earnings? Is it underperforming going to earnings? On average, that will probably tell me more than a lot of other things. So there's a good question here. Grace is saying, how do you justify a company like Whirlpool, the consumer discretionary, having EPS of forward EPS of 14? Do I also look at expected EPS growth and revenue growth relative to the S&P 500? So here's the thing, is that most stocks you can look at relative to the S&P 500. Some stocks you have to look at relative to their peers. A good example of that is like airlines, banks, energy stocks, mining stocks, those types of supermarket stocks, because those are businesses that are not scalable. What do I mean by that? When you build, like, for example, you look at a company like Microsoft or Apple, or let's look at Microsoft as a better example. When Microsoft builds out their Azure cloud, right? Once they build out their Azure cloud, it's a much more scalable business. Whether they sell it to one client or 100 clients, selling to 100 clients doesn't cost them 100 times more to sell to 100 clients than it costs them to sell to one client. Versus if you look at a resource stock, right? You look at an oil company, right? For them to sell 1 barrel of oil, they have to extract 1 barrel of oil out of the ground in order to sell it. they want to sell 100 barrels of oil, they have to extract 100 barrels of oil out of the ground. There's obviously some synergies, the more you extract, the less it costs per barrel, but it's still going to cost you a much more linear model in terms of your expenses, right? So companies where the expenses are linear, they trade at much lower multiples. That's why airlines, supermarket stocks, these are the types of stocks, they trade at very low multiples because for every unit that they sell, they have to acquire a unit in order to sell, and that's a very linear uh, expense chart, if you will, right? So for every one unit that they want to sell, their expenses grow by roughly a factor of the revenue that they generate. So whenever you have a more linear scaling of expenses, the lower multiples that they trade at. The more scalable your services are, the higher the multiples. So that's another component to look at, and that is more industry specific, right? You don't have to look at each individual company per se. There are just certain industries that will always trade at a low multiple, like car manufacturing stocks, supermarket stocks, airlines, banks. What's another good one? Energy, resource stocks, so energy companies, mining companies, utility companies. These are the ones that, where expenses are linear and they trade at lower multiples. So hopefully that sort of answers your question. Whirlpool, for example, is a good example of that from the perspective of every single dryer that they sell. They have to manufacture a dryer, and there's not a lot of, for every dryer they make, but they have to buy all the parts to make that dryer. They can't really scale that up very much. So for those reasons, they tend to trade at a discount relative to the S&P 500. So I haven't looked at Whirlpool specifically, but you have to factor that into your decision-making process. Does it also make sense to look at relative strength versus sector peers? You absolutely can do that, right? That's another kind of form. The question is really, when you look at this relative chart, right? Do you look at relative to the market, or do you look at relative to its peers, or relative to its industry or sector? You can, but I tend to find that there's very few cases where a stock is outperforming the market, but it's not outperforming its sector, or vice versa. So I always like to use the gauge of the S&P 500 as a starting point, but yes, you absolutely should, if you can, dive a little one level deeper to say, okay, is it outperforming the market, but is it also outperforming its sector? How do you handle deep in the money long leaps going into earnings season? Can you cover the long leap with a 15 delta cover call that comes up under OptionsPlay and OptionsPlay? So if you have a long position in a stock and you believe that it's going to underperform going into earnings season, then yes, you absolutely can sell a cover call. You theoretically can sell a cover call even if you think it's going to do okay on earnings season. The only time you don't want to sell a cover call is if you think the stock's going to make a big jump higher. In that case, you should just hold on to your long calls. Is it beneficial to do both a credit and debit spread, as you will always be on the right side of the trades? You won't be on the right side of the trades, if you do both a debit and credit spread, if it's in the same direction. Because if the stock goes against you, now you have two trades that are working against you as opposed to one. I could see someone saying, I was going to commit $1,000 to a trade. Now I'm going to do 500 on a debit spread, 500 to a credit spread. Maybe you could do that. I honestly haven't even thought through what that would mean for you. It certainly would negate some of the time decay factor if you were to use a combination of a credit spread and a debit spread. But I wouldn't just double your trades by doing, a debit spread and a credit spread to try to cover all bases, because you're not, right? You're still taking a directional view. And if you get that directional view wrong, now you've just got two losing trades as opposed to one. Can you show the calculation for the expected move using a straddle? Sure. So expected move is simply taking the straddle. So let's look at American Express just for argument's sake, right? American Express expires tomorrow. We'll take the at the money straddle that expires this Friday. So if you look at the at-the-money straddle, it's currently pricing in at $10.80. So this is the July 19th, which is tomorrow, 250 straddle. This is the at-the-money straddle for American Express. It's priced at around $10.80. And what that means is that the expected move between now and tomorrow is about $10. So the market is basically saying it could be, there's a 68% chance it will be between 260 and 240 by tomorrow's close, right? So because earnings is tomorrow, it could make a big move. And there's about a 68% chance that the stock will end up somewhere between these two numbers. That's how we kind of use straddles to kind of calculate a back of the envelope expected move for earnings. So you can use that to kind of gauge your strike prices, right? So if you're going to buy a debit spread, you generally want to sell the 240s or 260s, depending on whether you're bullish or bearish. But that's kind of the thought process behind using straddles to calculate expected move. How to use stockcharts.com with OptionsPlay? Right now, there's no integration between stock charts and OptionsPlay, but we are working towards that. So I'll have a lot more to share with you in about a month's time with regards to kind of an exciting partnership we have with stockcharts.com. But it's a package that I use a lot in my own personal trading. There's a lot of features. I'm actually going to likely do a session on just kind of how I use stockcharts.com in the next few weeks, just so you guys can kind of see my workflow and why I use stockcharts.com and why I think it's so powerful. But there's a lot more that I'll be announcing in about a month's time with regards to a bigger partnership that we have with StockCharts. If this service is okay for beginners in options trading, I would certainly think that OptionsPlay as a tool was built for traders who are relatively new to options trading. We specifically designed this tool to make it far more easy to navigate than an options chain, where you have to look through hundreds and hundreds of strikes and expirations and figure out what strategy you want to trade, what strike and expiration you want to choose from, and analyze those trades. We basically take all of that away from you and give you only strategies that make sense given what outlooks you have on a stock. So whether you're bullish on a stock, we give you starting points. Bearish, if you're neutral on a stock, we give you all starting points so that you don't have to figure all that out for yourself, and then give you the underlying metrics to kind of make your decisions and even kind of explain things to you in plain English, so that you can kind of understand these strategies better before you start executing them into your live account, or even doing it, if let's say you connect a TradeStation, you can even do it in a paper trading account, or we even have paper trading designed into our platform, so that if you want to paper trade these trades, you can simply add these positions to your portfolio and track it using OptionsPlay as a paper trade. So there's a lot of features built into OptionsPlay specifically designed for beginners to help you kind of get started. What are the bracket orders that I should add to the orders? So whenever we post a trade idea, we also always give you kind of stop loss levels. You can also put in some take profit levels as well. And you can use bracket orders to kind of trade to kind of trade both sides. We actually have videos on that on our YouTube channel for placing OCO orders, so feel free to kind of take a look at that. As far as, I had a few questions of people asking me, where do I get my fundamental numbers from? The thing about fundamentals is that it's basically commodity. There are dozens and dozens of services that sell, these types of fundamental numbers that you can subscribe to. I don't particularly have one that I love over another one, because like I said, it's all the same stuff, right? Just being sold by different vendors. Just kind of find a vendor that works for you at a price point that works for you. Yeah. Ben, did you post Tom Sosnoff's webinar slides with your comments, and where? Yes, they are posted on the YouTube channel. If you go to our YouTube channel, youtube.com/optionsplay, I think it's one of the latest videos that has been posted, and in the description is a way for you to download the links. I uploaded those links on Monday with kind of the notes from Tom. For those of you that joined us last week, we did a great session with Tom Sosnoff from Tasty Trade, where we went over different option strategies and what are his best practices for those strategies. And I updated those slides, so you can download those slides from the YouTube description. That will give you an overview of what Tom said as his best practices for each one of those strategies. So you can watch the recording and follow along with those slides. Please review the 3 parameters you use to choose an options trade for earnings. So absolute strength or weakness, relative strength or weakness that aligns with that absolute strength or weakness, and then a fundamental picture. Vikram, thank you so much. I really appreciate that. You guys sent an incredible amount of feedback after I hosted Tom Sosnoff last week. So we already have another Tom Sosnoff webinar planned for same time in October, right before earnings season. So really looking forward to that. I spoke to Tom just earlier today. He wants to do more. So maybe we could even do one before October again. So we'll keep you posted. But Tom is great in terms of what he's able to talk through, and really looking forward to doing more with him as well. Could you provide more on our evaluation process and how to do it? I would say join us on our Monday morning sessions, and you see me go through 5 or 6 different examples every single Monday morning. It's going to help you catch on much, much quicker. But watch the recording, right? Because I went through, I would say, that kind of 5-minute masterclass on how I think about valuations, and it really summed it up in those 5 minutes. Watch that recording. I think that'll give you a lot more insight. And then coming back on Monday mornings after watching that 5-minute overview that I just gave during the session will give you a lot more insight into how to utilize those for your trading. Is the IV higher for credit spread if earnings is before the expiration? No. If earnings is before the if earnings is before the expiration, then yes, IV is higher. But if earnings are after the expiration, then the IV won't be higher. How about non-directional strategies like straddles, strangles, calendars? Those are very common as well. We can't cover all of them here. I would say that the credit spread is somewhat non-directional, right? It's got some directional bias, but it is a non-direction. It can be a non-directional strategy. I usually don't see a lot of traders that truly have no directional view going into earnings, right? Usually have some directional view, which is why I think it's important to cover some of the strategies that we did here today. With that, though, that is all the time that I have for questions. I hope that this was helpful in giving you a better sense for the upcoming earnings season and what tools you have at your disposal here at OptionsPlay to help you navigate that earnings season. Incredibly important for you to be able to have access to the earnings calendar, which again is under the hamburger menu inside of the earnings link on the hamburger menu. Once you do go through all that whole process of figuring out which strategies to trade, that's really kind of where you come back to OptionsPlay. You either select bullish, bearish, or neutral to find the credit spreads to trade, and this gives you access to the ability to execute these trades into your brokerage account. With that, thank you so much and have a great trading day.